Many people tend to avoid talking about money since it is such a touchy subject for them. In fact, the subject may get so heated that some will stop handling their finances altogether. In a nutshell, there are two types of people, those who enhance their wealth and those who lose it. In this video, I will share with you 9 money blunders you must avoid, and if you're new to the channel, hit the subscribe button below for more information. The truth is that it is a lot more difficult to keep money than it is to make it. It is not uncommon to see people who come into wealth through inheritance, the lottery, or other windfalls and lose it in a short amount of time. The famous boxer Mike Tyson is a good example of someone who earned a ridiculous amount of money but lost it all. Even though he made over $300 million during his career, he filed for bankruptcy in 2003 and was reported to be in more than $20 million of debt. It goes without saying that money mistakes happen, and these mistakes can cripple your finances regardless of how much money you make. So let's get into the 9 mistakes you must avoid. Number 1. Spending too much money on caffeine and cigarettes. If you calculate how much money people spend on coffee and cigarettes, it can add up to more than $3,600 a year if you're spending on average $10 a day on caffeine or coffee or cigarettes. Not to mention that these can have negative effects on your health. Number 2. Spending more than you make. The majority of individuals believe that they should treat themselves after they are paid. Nevertheless, a rise in salary should not always lead to an increase in your cost of living. Instead, this cash flow should be channeled into prolonging your wealth through investments and the acquisition of assets. People probably spend more than they can afford to because they want to impress their friends. Sometimes they feel inadequate in comparison to other people. However, this line of thinking is flawed because, as Dave Ramsey says, we buy things we don't need to impress people we don't like, and many of us are guilty of this. Once you learn how to delay gratification and forget about impressing other people, you will be able to be intelligent, develop a budget, and keep track of your expenditures to ensure that you don't blow through more money than you bring in. Number 3. Not making prudent investments. When it comes to investments, things can get really complicated, and many people choose where to put their money based on recommendations from others or a firm belief that the prices of popular stocks will continue to rise. However, there is one type of asset that almost everyone seems interested in these days, and that is real estate. Many people believe that once they purchase an investment property, they will no longer need to worry about their financial situation. They believe that the monthly rent payments will pour in and their income will increase exponentially. However, this is not always the case. Sometimes tenants miss payments, appliances break, and the value of your property declines. As with any type of investment, there is an element of risk involved. As an astute investor, the key to ensuring that their assets produce a reliable stream of income is to manage their assets effectively. Number 4 is getting involved in get-rich-quick schemes. There's an old saying that says, easy come, easy go, and following get-rich-quick schemes is a great way to get into difficulty. These schemes are one of the surest ways to lose your money. These things include things like Ponzi schemes, pyramid schemes, and make money overnight offers. These schemes are all set up to make the scheme originator rich by taking your hard-earned money, and you should proceed with caution if you are looking into new business ventures and see opportunities that promise high returns with a small risk. If it takes a career of 20 years to make $200,000 and a new venture says you can make money in a year, wouldn't everyone be doing it if the benefit was legitimate? In short, when it comes to making money quickly, you should always use your best judgment before signing on the dotted line. Number 5. Having no money set aside for unexpected costs. Let's face it, life doesn't always go the way you want it to, and sometimes you need to cash in order to rectify the situation you're in. For example, your car may suddenly stop working and you could lose your job, or your appliances could break down. Unfortunately, just about everything in life costs money, which is why failing to have an emergency fund set aside is a critical financial mistake. Sadly, a survey conducted by the Federal Reserve in 2019 indicated that approximately 40% of people living in America would not be able to meet a $400 emergency with cash reserves or a credit card charge that they could rapidly pay off. It was found that approximately 27% of those polled would need to sell something or take out a loan in order to come up with the necessary $400. An additional 12% of those polled wouldn't be able to cover it at all. However, you don't have to be one of these individuals. It is possible to save these funds easily. All you need to do is set up a 10% automatic deduction from your pay with your employer. This will cause a portion of your paycheck to be sent into an emergency savings account. However, how do you know when you've saved enough? Most financial experts recommend that you should save 6 months worth of living expenses. However, if you want to be extra cautious, then 1 year's worth is better. Number 6 is having just one source of income. For most people, having a single source of income is a way of life. They get most, if not all, their income from their primary job. But with the way the economy is these days and constant news reports of people getting laid off, and having only one primary source of money is proving dangerous. If you find yourself in this boat, try to use your extra time each week or weekend to try to create an additional stream of revenue. These small revenue streams may start off small, but over time can grow and maybe even replace your full-time income. Number 7, relying too much on credit cards. The use of credit cards encourages impulsive purchasing because it gives you the mentality that you can afford anything and everything with a single swipe. Relying on them heavily can ruin you financially. Large credit card interest rate can also quickly make small purchases seem overwhelming, so be sure to use credit cards only if you're able to pay them off at the end of every month. Number 8, being afraid of taking financial risks. Fear of taking financial risks can paralyze you financially. People who are afraid to take chances are the ones who save all their money. And when you leave money in your bank account, you're tempted to spend it on material goods like a new car, new clothes, or entertainment. However, you should put that money to work for you by investing it, whether it's in the form of stocks, real estate, or another investment vehicle where you are familiar with it. In a nutshell, you should make it easier to save money for yourself so you can invest it rather than saving money just for the sake of saving money and letting it sit in a zero interest earning bank account. Number 9 is having only one bank account. Having only one bank account is risky for a few reasons. First, having only one bank account will make it really difficult for you to manage your money. When you work with just one bank account, you have to keep all your emergency funds, college savings, and money to pay bills all in one account. And if you accidentally splurge, you risk not having an emergency cash or tuition money readily available when you need it. This is why you should always have different bank accounts for different purposes, like one for emergency purchases and one for tuition and one for daily living expenses. That wraps up this video. Hope you learned some great life success tips in this video. Make sure you hit the subscribe button and see you next time.